Hello again, everyone. This is Gene Ahrensberg coming to you not far from a favorite fishing lake, but thunderstorms and lightning are not good for fishing, so why not cut a video? Despite gold-friendly monetary easing out of the European Central Bank, which cut interest rates to a new record low, China dropping interest rates, and further quantitative easing out of the UK, immediately following the release of the U.S. non-farm payroll report, which showed a disappointing 80,000 jobs were added for June, gold and silver sold off in thin holiday trade. The U.S. dollar spiked up fearfully, and the euro tanked. We had a news-assisted mini-earthquake, in other words, and some of the knee-jerk reactions seemed kind of counterintuitive. Gold and silver finished the week down a little over 1%, and we saw a little negative money flow from the metals ETFs. But mining shares ended the week not far from flat. While we wait patiently for new commitments of traders data from the CFTC, which we should get to see on Monday, July 9, I thought we would discuss some of the thinking behind our attempted short-term trade for gold and silver. Today, let's focus on silver specifically, since our view is that the silver futures market is skewed short and about as contrary bullish as we've ever seen it. We talked about our trading history in the last video on July 1, so we won't recover that here. We re-entered our short-term trade at and just above the green, which marks where we look for important technical support to hold. Since January 2011, silver has tested the $26 support level 5 times, but this is the first time that the test hasn't just spiked higher and kept on moving higher. Each time, up to now, the price has been repelled sharply higher, as heavy demand for physical silver showed, and as the bears' selling pressure ran into heavy buying pressure, paper and physical, and that resulted in those long tails visible in the weekly trading bars. That was up to now. This test is already different in that we're not seeing much follow-through to the upside, which is to say that this time the bears are more confident in their positioning. They're not so quick to run, so to speak. Their confidence is higher because for a year now, silver has been in a relentless downtrending channel of lower highs and sort of constant lows. The bears have not been mistreated for too long, as we might put it, so they are becoming fearless and overconfident. What the bears are counting on is that there's a holy grail of sorts located just under that obvious $26 support, and if they can only get the trading down into it, if the bears can break this big descending triangle formation, they believe it'll trigger an avalanche of trading, trailing, and sell stops. And as of right now, the price is close enough to the break point that it must look delicious to the silver bears. We can imagine them salivating and very confident that if they can press silver below the $26 target, the silver market will implode on its own force. All they have to do is push silver across that Maginot line, and they get a bigger payday. And from the bear's point of view, the silver setup is pretty clear-cut. The setup is irresistible to a short seller. They're at the goal line, so to speak. And from their point of view, there's no question that silver has been in a long-term downtrend. There's no question that since silver has repeatedly shown support near $26, there has to be an enormous number of stops which reside very close to that line in the trading sand. And there is no question that if the bears see a $25 handle on the price of silver for more than a few minutes, they will see the greenest of green lights to sell the bejesus out of silver, to give it a good push off the breakdown cliff. In their mind, it would be their duty to sell silver short once a clear break is showing. Can the short sellers manage to get silver below $26? That's the $64 question. On the one hand, Silver has not shown a significant bounce and follow through as it has in the 5 previous challenges of the support level, so that has to be encouraging to a bear. The more that silver does not show strength and follow through, the braver the bears become. But, and this is key, we think, some of the selling pressure of late is in the form of delta and have-to hedging by the long camp. They don't want to be short, but they are already long, and they've been taking short positions as insurance, as we talked about in the last video. Remember, the funds were showing their largest ever short position in silver futures, the normally net long funds. Let's zoom in a little closer. And that means that somewhere not too far above the mark today, there is a corresponding buildup of short trading, trailing, and buy stops. That stack of buying pressure is likely not as concentrated as the one the bears are shooting for, but it likely resides just above that minor downtrend line showing on this 1-year daily graph. And here is the good news for those attempting to game silver long here at $26 support. The area where the buy stops would kick in is getting lower and lower each week. The distance between the bunched up buy and sell stops is contracting. So perhaps rather than silver needing a $31 handle to trigger buy stops as it did in early June, we figure that the buy stop triggering zone has drifted lower now to perhaps call it $29.50 to $30.50. It's not a science guessing where the stops will trigger, it's more of an art. But the parameters are tight. They're not dispersed. They're within narrow limits, in other words, and all veteran traders know this. I think we would know for sure if silver moved up to and through $30. Such a move by silver would put a little fear in the bear camp for the first time in quite a while. It would negate a perceived inverted cup with handle breakdown, and it might trigger the massive short covering we have taken our new position to try to capture. The setup is very interesting because we could be seeing short covering by both sides of the silver battlefield by bulls and bears. Bulls buying a breakout and covering their short hedges, and bears having their trading and trailing stops triggered simultaneously, taking profits. And nothing moves the market faster and more violently than when we have such a key reversal and both sides are trying to buy at the same time but for different reasons. That's what makes key reversals so beautiful. At any rate, we want to emphasize and make clear that yes, $26 could be a trap door. If $26 is breached, we're very likely to run for safety right quick. But friends and fellow vultures, something like $29.50 to say $30.50 could also be a launch pad of epic proportions with the silver futures market skewed so heavily and unusually short. The reason we have chosen to take a shot here is simple. There is a clear area to place our stops, to run for the hills if we're wrong, or if happenstance gives the bears an assist. And it is at a near enough level to be a small percentage relative to the clear and unambiguous amount of potential upside potential should our trade meet with providence and it is the bears taking profits and running for cover instead. That's why we'll be quick to exit if $26 gives way. Right or wrong, if silver shows a $25 handle for very long at all and it doesn't bounce immediately back above the danger line, we'll run to the sidelines without delay and let the trading elephants duke it out on the futures battlefield all they want. The object of trading is not to be a hero. Heroes in trading are not awarded medals, they get their heads handed to them. The object of this trade is not to try to catch a further lower low. It is to catch the bounce that will come with a breakout up and into the buy stop bonanza that lies just above the mark if we get it. We're willing to risk the chance that the bears prevail here because the upside is likely a much higher number if the bull team wins, and our stop will hopefully keep us out of trouble if the bears manage to win this particular battle. Now, We're going to wait to update our technical charts this week until we have a chance to see the COT data to be released tomorrow, Monday, July 9. But we did notice some supportive signs in the data this weekend. And here's just one of them, the future strip for silver. This is the silver future strip courtesy of InsideStocks.com as of the close on Friday, July 6. We believe that when the cash or spot price closes higher than the front contract, it means that the collective market is willing to pay a premium for physical metal for now delivery, even when the traders could just buy a futures contract that expires shortly at a significant discount. It's called backwardation. Note, please, that on Friday, July 6th, cash market silver closed at $27.09. In this example, the cash price is not only higher than the near active contract, September, at $26.92. Spot silver also closed higher than December 12, higher than March 13. In fact, cash silver closed higher than all the other contracts on the COMEX bourse. Why would anyone be willing to pay more for their silver than they have to? That's one sign that supplies of silver for immediate delivery are seeing good demand. It is also a sign that sellers of paper silver are overrunning the market's ability to deliver silver, and as one trader we correspond with says, when the market is in backwardation, the shorts are on borrowed time. And we sure hope our friend is right. But if not, well, that's why we use trading stops. Now we have some time left, and I'd like to take this opportunity to look once again at the chart for the smaller, less liquid, and more speculative miners and explorers that we find on the Canadian Venture Exchange, which have been so mistreated by a fearful, uncertain market in 2011 and 2012 so far. What I'm about to say is not new, but it defines the vulture mindset, and it's kind of the law we live by as uber contrarian vultures. That's with the CDNX and its second largest sell-off ever. We think it's important at times like these to remember that in a panic sell-off or in a long-term super negative liquidity event, or NLE on our charts, value becomes an abstraction. It's a theory. Instead, the raw and brutal laws of pure liquidity show their absolute dominance. When there are more than 1 million shares of an issue on offer, but only a few tens of thousands of shares or so on the bid, the price contest is no longer fair or, for that matter, accurate. And we think it helps to view the shares of the small resource companies we love to game here as more like long-term options. They are call options with no time meter on them. They don't expire unless the company does. Options can be very volatile, and options traders are used to that high volatility. Vultures know and believe that high volatility is ultimately our friend. As I go through the remainder of these comments about the companies we call the little guys, I'm going to be putting charts up of some of the companies we have chosen to game here at Got Gold Report, and I've added comparisons to 3 of the important small miner indexes for reference. Now, before we lose power again, let's get back to our charts. Thank goodness for battery backups. Vultures learn not to worry so much about price at times like now, and like we saw in 2008. Really, what difference does it make what something sells for in a panic? It's not real value, you know. It's a distressed on sale price, nothing more. Nothing has changed about the guru chosen company we like very much, except that the market cap has fallen off a cliff, and it's cheaper now. A market like this takes no prisoners. It mistreats them all. And we can own more of them for the same money, assuming we've got some resources left to deploy, and isn't that a good thing? We're certainly not going to sell at a panic price, so why does it matter to us? In fact, we've been selling a little of our gold recently so we can take advantage of some of these screaming bargains, or at least what we think are screaming bargains. Except for the issues we really want to add shares in, a panic sell down is merely our chance to understand exactly how much volatility is possible for the other issues we hold or track, even in an anomalous panic event like this one. That's easy to say, we know, but to the extent that one can adopt that kind of philosophy, it really will make life more pleasant. Nasty sell downs are just time killers to vultures, moving the eventual day of profit taking farther out into the future. But for the issues that we really want to increase our size in, these anomalous panic sell down events are true gifts from the trading gods. It's a chance to add shares in the companies we have developed strong confidence in at super bargain prices. And isn't that what our reserves and some of our accumulated gold are there for? To deploy into super bargain prices on the companies we really like, or perhaps the ones we sure did want a piece of before they got away from us in the past, when there are seemingly only sellers and no buyers. It just doesn't matter a whit what some small resource company with light liquidity and little or no institutional support ought to be priced. Makes no difference. It ends up being low priced to the extreme by an irrational and panicked market. Many of the stocks we follow prove the theory that extreme mispricing is not only possible, it is expected during times of severe market stress. Please don't take this as being cavalier, but so what? We figure that even if we plunge into another 2008 style abyss, the world is going to want gold and silver above all other assets, and therefore it will also want the miners and explorers that are looking for and producing them. During the panic phase, there seems to be nothing but down on the charts, but the panic phase will not last forever. As card-carrying vultures, we have already waited patiently and attempted to buy our various positions at what should have been overwhelming support in any normal market. In some cases, we waited until the issue we track reached our coveted stupid cheap and ridiculous cheap, and only then we pounced. So we're already in at low levels in a normal but beaten up market. In a panic scenario, even if our positions trade to as much as 50% or more below our entry, and who cares if it does in a panic, the vast majority of other shareholders in that same company paid a ton more. What is surprising to us is when we look back over the charts from 2008, we're struck by just how few shares, how little volume actually traded below a certain level on so many of the little guys we track. Take a look at the Timberline Resources example as evidence. The 2008 collapse for TLR was definitely not a high volume affair. The good news? Well, it may sound Pollyanna to say it in the current environment, but we can say with authority that once the panic subsides, and it will subside at some point, once the extreme negative liquidity event expires, guess what? An amazing transformation occurs over a relatively short period of time. Seemingly as if a switch is thrown, the liquidity turns from hugely negative to modestly positive. Optimism and positive liquidity begins to take hold, and presto, it doesn't take really all that much buying pressure to get the stock to move. And using this Timberline example, it went from 19 cents to $1.60 or so in a few months once the head vice had released its pressure. So in March of 2009, when the world felt like Armageddon revisited, 100,000 shares of Timberline could have been had for $19,000. Now, if you were patient and diligent on the bid then, that same stake would peak 6 months later at just over $160,000, or about a 7-bagger. That's the power of penny leverage. And even in a really bad market, like the one we've been in, 1 or 2 or 3 of our faves just might drill a spectacular glory hole like Goldquest did last month in Dominica at their Romero deposit. Even in a market from hell, we've got a shot at a grand salami. We're out of time, so let's close with an important idea. The vast majority of people who attempt this game get frightened, and they panic, and they sell when the pain gets to be too much to bear, and so on. A vulture is wired differently. It is vultures who are there to buy when others are panicking. Now here's the important part. How many market-wide panic opportunities are we likely to get in a trading career? Believe it or not, most people can count them on one or both hands with digits left over. Panic-motivated extreme sell downs are rare, but they're temporary opportunities, and we should welcome them. They are to be embraced and to be taken advantage of in the market's chosen time frame, not ours. We don't get to choose the timing. Vultures. True vultures are immune to panic, worry, and fear. No, that's close, but not quite it. True vultures become excited and energized by the fear, panic, and worry of others. Indeed, we pretty much live for it. Until next time, thanks for watching, and very soon now we'll be able to place these private Got Gold Report videos directly on the subscriber pages, so look for that development soon. Bye for now.